Hi, I'm attorney Bill Bronchick, and in this video I'd like to review with you the due diligence and the logistics of doing a hard money loan where you are the lender in that case. So the first thing you want to do is to make sure that the borrower is someone you want to lend to. So number one, you want to do your due diligence on the borrower. Now, when I say borrower, is this an entity you're lending to, like an LLC or a corporation? Not a bad idea to get a personal guarantee in addition to a signature of the borrower as, let's say, manager of the LLC. And it's very simply done by, on the promissory note, just having two signatures, one on behalf of the company and one individually. And that will, in the case of default, not only can you go after the property and the LLC, but you can go after the individual and his personal assets. So that'll give you additional protection. But more generally, you want to do your due diligence. You want to get a credit report, not necessarily to see the FICO score, but to see how leveraged and what kind of trouble they might have been in the past or might be looking at in the near future. You want to get some references. You want to get bank statements, maybe 2 or 3 months worth of bank statements to show that they have some money in the bank to make the monthly payments on the note. And by the way, there's two ways to do it. You can get monthly payments on the note and have a balloon, or you can just have no monthly payments and have it all accrue and then get paid at the end. Borrowers prefer it that way, but I like the former because if they're going to default, I'd like to know earlier rather than later. So if you have a 6-month balloon, and you won't know until 6 months are up whether or not they're going to default. And whereas if you have monthly payments and they default on payment 3, well, then you have noticed they're not going to make the payments earlier. So earlier is better than later. So do your due diligence on the borrower. Number 2, do your due diligence on the deal. So does the deal make sense? What you'd like to see is if this borrower you're lending to, let's say it's going to do a buy, fix, and flip, you'd like to see a spreadsheet of their numbers, what they think it's going to cost to fix, what kind of profit. Does the deal make sense? Because if the deal doesn't make sense, first of all, ethically, I don't think you should be lending money to someone who's not going to make any money and you're making all the profit. But you just don't want to lend to someone who's in delusion land. If you look at their numbers and it looks like they think they're going to sell it for $300 and the neighborhood and it's only going to be $250 after repairs, then red flags should go up that you shouldn't be lending to someone who doesn't know what they're doing. And you want to make sure that their players are good. They have contractor who's doing the work. Preferably they don't do the work. Someone else does the work who's a reputable contractor, pulls permits and so forth. So make sure the deal makes sense. Third, do the due diligence on the collateral, the property. Is there enough equity? And I would recommend, obviously, be in first position. You could be in second position, that's okay, as long as the total position that you're in is no more than about 65-70% maximum of the value of the property. And now when I say value, some lenders will go based on as is, some will go based on after repaired value. It's fine to go with after repaired, but if you have money that you're lending them that they're going to use to fix it up, don't hand that over at closing. Put it in an escrow, and when they do the work, or as they do the work in chunks, you can release that money from escrow. Otherwise, they could just take all the money and run, and then your after repaired value isn't there because it was never repaired. So, good tip there. So, make sure, of course, you do a title search and get a title insurance policy that guarantees that you're in first or second position. There are no other liens on the property. You want to make sure that the borrower, has the legal authority that they are the owner, or that their LLC or whatever is the owner, and they have the right to convey a mortgage or deed of trust as a lien on the property. So due diligence on the borrower, number 1, very important, on the deal, on the collateral, and then number 4, your due diligence on the paperwork. So you want to make sure you're in compliance with any applicable state laws that come with commercial lending. And in most states, there's very little, if no, regulation on commercial peer-to-peer lending. That is, you're lending to someone who's not going to live there, and it's a company. So first of all, you shouldn't lend to anybody that's going to live there, or even you suspect is going to live there, because now you're a consumer lender, and there's all kinds of state and federal restrictions and laws and things you can trip over. Do not do that. So if you're lending to someone who's a company, clearly not something he's going to live in, then you're in commercial lending, and again, very little regulation. Some states require that you do have a license if you regularly do loans. Some states may have particular disclosures. You have to worry about a usury rate in the state. So for example, if the usury rate is 21% or even lower, 18%, and you're charging 15% plus 5 points up front, well, on a 3 or 4 month loan, that's clearly total interest more than 18%. So make sure you understand what the usury law is and whether or not points paid up front are considered part of the interest being charged. You want to get a promissory note, again, signed individually by the borrower in addition to maybe their corporate entity. You want to make sure you have an adequate mortgage or deed of trust. And again, I can't stress this enough. Use an attorney to come up with a good set of forms for a note and mortgage or note and deed of trust. And make sure that every I is dotted and every T is crossed on this. I can't stress this enough. And make sure that it says in that mortgage or deed of trust that they must name you as an insured on the insurance policy. And in many cases, if it's a first mortgage, I would ask for proof of that insurance at closing before the funds are released by the closing agent to the borrower. So they have to show up with a binder or proof that upon payment, which the closing agent can actually collect the premium out of closing to pay for that. And then you have to decide whether or not you're going to roll the points that you're charging into the loan balance or whether you're going to make the borrower pay up front. Again, the more they have out of pocket, the more skin they have in the game, less likely they're going to default. So especially if someone you don't know, I'd probably make them pay the points up front. Make sure that they have the reserves in a bank account for the monthly payments on the note, and make sure that they are someone that obviously you want to lend to based upon your due diligence on the person. And the last thing I wanted to mention about this and the due diligence is to make sure that you're in compliance with any particular loan regulations that might apply for doing like what's called the truth in lending, or any good faith estimates or disclosures that are required by state law. Again, very few states have a lot of regulations on hard money loans, but you want to talk to the attorney and make sure that they advise you of any rules or restrictions that apply to this, because if you're not licensed, you may have to do your loans through a licensed mortgage broker or originator and split some of the points you're charging up front with that person. Okay? So again, number one, do your due diligence on the borrower. Most important thing. Do your due diligence on the deal. Does it make sense? Is it a sound business plan that the borrower has? The collateral, is it adequate? And by the way, in terms of collateral being adequate, always, without exception, personally visit the property. I can tell you from experience the times I got burnt doing hard money loans is I relied on an appraisal and didn't get my eyeballs on a property that I ended up getting back that I realized afterwards was not a property that I wanted back. And even though the appraisal said it's worth X, neighborhood wouldn't support it and I couldn't sell the property and I ended up having to do something else with it. So visit the property, and you should make the borrower pay up front for an appraisal if you're not sure of the value. Non-refundable. They pay for an appraiser picked by you, not picked by them. And secondly, make them pay for an inspection. Your inspector, not theirs. So again, if you get the property back, you don't want to end up with something with a meth lab or a foundation problem and so forth. So you got to have all the due diligence on the collateral, and then making sure you have a good paperwork that an attorney drafts up and be in compliance with any applicable state lending regulations that might come into play. All right, that's the gist of it. Go out and make some good money doing hard money loans. My favorite way to do it is inside of a self-directed IRA where you really get some great returns. This is Bill Bronchick. I hope you've enjoyed this discussion on how to do a hard money loan.